Okay, good afternoon. Good afternoon. Can you hear me out the back? Okay. Well, welcome back to week 8 of the course. So, what I want to talk about today is something that you don't hear about in a normal finance course. It's surprising that you don't, because the kind of topic that it addresses is fairly central to a lot of valuation. In fact, how central is it? Let me give you an example from today's paper, or the paper of the weekend. Okay. The paper of the weekend talks about Uber. Uber is having an initial public offering, and it's going to sell about $10 billion worth of shares, which will value the company at somewhere between $90 and $100 billion. So, you think, all right, let's do a valuation of this company. Let's look at the cash flows, let's discount them, and let's see whether it's worth between $90 and $100 billion. Except that the company, you look at the annual reports, and you go to the company, and it says, and this is in the prospectus, right? So this is in the document that they're giving to you to tell you to buy these shares. Here, buy these shares. It has 91 million users, but growth is slowing down, and we may never make a profit. Does that sound like an attractive offer to you? Buy my company. I want $10 billion from you, but I don't think there's a good chance we'll never make a profit. The same company, a different company with a similar kind of model, Lyft's IPO, raised $24 billion in an offering that was valued at $24 billion in an offering that raised $2.34 billion. And it was down 11% at $60.12, below their IPO price. So it's the first in a series of high technology IPOs, including food delivery services and smart exercise bike Peloton. Now the thing is, and this is the bit, so we're looking at this, you talk about a finance course, and traditional finance theory does have something to talk about this, which is what I'm going to talk about. But except that the puzzling thing is, it's very rarely mentioned. Which means that you find this kind of a comment. There's no discernible way these companies are valued. What you're really buying into is the long-term ability of the company to capture lots of sales and hopefully get profitable at some point. But yeah, well, it's true. That's true for lots of companies. But you at least expect some starting point where a company is saying, oh, look, we expect to make some profits in the future. This isn't now you might think this is a sign of the times, and in some senses it is a sign of the times because this is a technology IPO and these are very big sums of money that they're raising. But actually, this kind of issuance, where people are issuing shares for company on the basis of prospectus that on the face of it don't seem particularly attractive, is quite common. So we have Discovery as a Resources IPO in 2012. I put 2012, this is a real company. I could easily pick a company from the last couple of years, but talking about WA companies in a class like this will just simply bring me more trouble than it's worth, so I'm picking up a company that's decently far back to the future. But have a look at this. The company is incorporated for the primary purposes of identifying exploration projects in Africa. We're in Australia. And this is a company wanting to raise funds for an exploration project in Africa. They didn't go to Kenya, Nairobi. They didn't go to Johannesburg. They didn't go to Cairo. They've come to Australia. They didn't go to London, for that matter. And one reason why they might think is, well, one reason why they didn't go to all those places is because of this. We want to produce a commercially significant mineral deposit, but the company has no income-producing assets and will generate losses for the foreseeable future. How attractive is that? Yet the company raised $1.7 million. Now, that's not a big bickies. Compared to Uber, which is raising $10 billion, this isn't a lot. But by the same token, it's amazing that they raised $10, let alone $1.7 million on the basis of that prospectus. The other thing that's interesting is that this is equal to the median house price in Cottesloe. So it's funny that it's odd, because companies like Woodside, BHP routinely raise, you could get this money by going to the bank and saying, I want this to buy a house. Might be a bit more difficult now, but in the not too distant past, it was quite common, certainly back in 2012. So the question is, why do they pick this particular method of fundraising? Because it's quite expensive. You're raising so little money and you're using up 13.3% of the funds just in the fundraising alone. Compared to the US, where they had 41 IPOs that raised between 0 and 50, cost 4.1 million just on compliance. So the thing is, this isn't particularly unusual. Lots of companies, tens, 20s, up to hundreds on some years, depending how good the year is, raise money like this on the Australian Stock Exchange. And the proportion of them that lose money is in the order of 90%, upwards of 90%, lose money. And this has been known for years. In fact, this company was the subject of a reverse takeover by Aquis Entertainment. Aquis Entertainment runs a casino in Canberra. It's a Hong Kong businessman that's running. But the point is, in 2015, it was August 2018. It was taken over. So we need to explain this. We need a model to be able to explain why these companies, which don't seem attractive on the face of it, they're telling you they don't expect to make a profit, yet people give them money, and then they fail. That doesn't seem very rational. So the question we have to ask here is this: is the investor demand for Uber stock essentially the same as the irrational demand for Dutch tulips? So I mentioned Dutch tulips because 400 years back we had the first ostensible bubble, which was in Holland for Dutch tulips, or cryptocurrencies. So you can see over here. So the question we're going to address today is it the case of the markets really being irrational? Or is there some kind of a story that we can tell? Is there some way we can reconcile this with sensible economic behavior? So it could be like this, where we have people getting caught up in particular stories, some kind of narrative. And this might seem, I'm taking what is arguably an extreme example, although as I'll show you in a second, it's not so extreme. But this is, if you've gone to the men's urinal, you'll recognize something similar to this. This is exactly what this is, a urinal. Marcel Duchamp put this out there called Fountain, and it's named the most influential work of modern art by 500 critics in 2010. This was a pineapple that Ruari Gray and Lloyd Jack Robert they left it at an art exhibition in Scotland, and they left it there for a little while, and they came back, they found a group of people lying around, and they said, oh, a bit of art, and they were critiquing it, and then it eventually got taken up and put in this thing. So the points I want to make today are three things. I'll be spending the most time on this, a little bit more time explaining this, and hardly any time on the different kinds of real options. I'll require to read that, but I just want to motivate this with the first group. So I want to talk about the role of stories and what it means to know something. In fact, I think this might be the most interesting part of the whole lecture, certainly relevant to a lot more than simply investments. What does it mean to actually know something, and how do we know it? And the reason why that's important in the context of finance is when you know something about an investment, it doesn't seem to make sense. How do you know it doesn't make sense? And we'll look at that in relation to Tesla. We'll talk about social groups and knowledge. And then I've talked about the wisdom of the crowd, how the crowd might know more than an individual, which I think is something that's actually true. It's a valid statement. But the question then becomes, how do you distinguish between what the crowd knows, what's true wisdom, and when the crowd is deluded, which is the mass delusion. And then we'll talk about the real options value of investment as a way of making sense of all these and showing that there can be a rational basis for these kind of investments. Just the point I want to make here is that there is, in talking about this, you often get this situation. People talk about going to university, you get fake news, and the argument is the solution is education, not regulation. So supposedly, by coming to university, you get to distinguish between you learn the critical thinking skills that help you distinguish between fake news and real news. I don't think that's true. I think you and I are just as susceptible to fake news as everyone else. It's the same way about a bubble. It's a nice way of thinking, and maybe it builds up business for universities by getting more people to go there. I don't know if anyone's convinced by this, but certainly I don't believe that by getting an education, you're any less likely to believe in fake news than real news. People want to believe what they want to believe for a complex range of reasons, which isn't much to do with education, or at least with learning facts. So Shiller's bubble definition, this is related to this. So there's one argument is that there is a news of a price increase which spurs investor enthusiasm, which spreads by psychological contagion from person to person, in the process amplifying stories that might justify the price increase and bringing in a larger and larger class of investors who, despite doubts about the real value of the investment, are drawn to it partly through envy of others' success and partly through a gambler's excitement. So there's a sense here of if you read the book, his book provides a much more nuanced take on this, and I think it's a much more sensible things, but there's a sense when you read this that this is inherently mad, irrational, something akin to this kind of a situation where you have someone says here, I've got a stock that could really excel, and people says, really excel, sell, and it goes into a buying frenzy. And then someone says, sell, this is madness, I can't take any more, goodbye. So goodbye, bye. And then again, goodbye. So, yeah. There's this notion that maybe this is what's happening here with the stock market, in Uber or this Discovery Resources, this kind of nuttiness. I'm saying, not quite. The story that Shiller says, that bubbles are not about, in my mind, about the craziness of investors. They're rather about how investors are buffeted en masse from one superficial plausible theory about conventional valuation to another. And my point is, you can't get away from this. This isn't something that is actually you can be independent of. So this book, The Knowledge Illusion, makes the point that there is this idea of individual human beings as independent, rational agents. That's the ideal that you get at a lot of places like universities. People say, come to university and we'll teach you how to critically think, teach you to be independent, to make up your own mind about things. Don't believe what anyone else has said. And then if you don't write what they tell you in the exams, they give you a wrong answer. You can't come up. And my tip to you is, in your exam, I don't want to hear your ideas. I want to hear my ideas explained very clearly in this thing. So this isn't about you making up stuff to be independent thinking. And I'll talk a bit more about the exam later. But what they're saying here is that the very idea of individual thinking is a myth. Humans really think for themselves, rather we think in groups. And now that's typically thought of as a bad thing. In fact, that's actually a very good thing. We can't possibly know everything, so we have to rely on the knowledge of others. They make the point that individual humans know embarrassingly little about the world, and as history progressed, they came to know less and less. A hunter-gatherer in the Stone Age knew how to produce their own clothes, how to start a fire from scratch, how to hunt rabbits, and how to escape lions. Nowadays, we're much more specialized, so we don't know all these things. We think we know far more, but as individuals we actually know far less. Now they say embarrassingly little. Maybe. I'm not particularly embarrassed about this. I'm pretty happy to know what I know, the limits of what I know, and we're specialized. That's why I'm quite happy to live in the kind of society where I can rely on the knowledge of others. It allows us to do a lot more things than if everyone had to learn each individual, each competency for themselves. So my point is, what they're thinking as a flaw is not a flaw, but not a bug, but actually a feature, a positive thing, is my take on this. But it can lead us astray at times. There are some situations when you have competing stories, and then when you have a competing story, it becomes very difficult to work out what is the truth. So people asked to evaluate how well they understood how a zipper works, and people, zipper in their trousers, and they said they were then asked to explain how a zipper works, and most had no idea. We think we know a lot, even though individually we know very little, because we treat knowledge in the minds of others as if it were our own. That's there. So all of you know that vaccination is good, except there's a group of people who think anti-vaccination is bad. That's an example of the kind of thing I'm talking about, right? So what's the relevance to finance and investment analysis? The point here is that stories are important. You have so many different facts, so many different potential points of view. Stories are a way that we make sense of the world. You can't get away from stories. To give you an example, and I'll pick this particular example because it just illustrates the importance of stories in a different context, and also I'll be talking directly about electric vehicles in a little moment. But so politicians are very good at this, picking up on things that catch people's attention and then, tell a story about this. I don't I don't watch any TV, or not because I don't think it's a good thing. I just don't, for whatever reason. But so this kind of thing really passes me by. I'm kind of thinking, what's going on? Why is Bill Shorten, has he decided to pick electric vehicles as the number one, as one of his key promises, that by 2030 we'll make 50% of all vehicles electric vehicles? And then why is Bill Shorten, Scott Morrison, so much against this? It's because they're trying to get a story. They're trying to fit people, so they're getting one side of the story, the people who believe in a green future, electric vehicles, that's Bill Shorten, and Scott Morrison, probably because Bill Shorten got there first, is now trying to attack that kind of a story. So bringing all this back to finance, what I'm saying is that the traditional model of finance says price is equal to the expected cash flow discounted at a suitable rate, which is fine for lots of businesses where you have a traditional cash flow. What they don't tell you is this bit. So this is the bit that I'm going to talk about here today that isn't included in most finance texts, which means that a large array of investment opportunities are seen puzzling to traditional finance people if you don't take into account growth options. It just doesn't make any sense, in which case then we talk about bubbles. That's why we have so much talk about bubbles. So in the traditional model, we have the sales volume, profit per sales, discounted, and then you have these growth options. It is equal to the intrinsic value and the market price. The thing is that growth options aren't a sideshow. So you might think that growth options just account for a small or relatively insignificant proportion of the total value. It actually accounts for quite a high proportion. So up to $90 billion worth of a company can be due to its growth options rather than due to its cash flows, because it doesn't have any cash flows at the moment. So if given these high valuations, the question is, can these valuations be justified without invoking irrational exuberance? So go back to electric vehicles. We have here Nikola Tesla, and so, now this is a plug for finance. People talk about finance, and people say that we should have more engineers, more people who actually do things, rather than unproductive people like financiers. So Nikola Tesla was one of these very productive engineers, a genius. I heard about him when I was driving. I had a long taxi ride away from the airport one time, and this Serbian, this taxi driver from Serbia told me all about Nikola Tesla all the way. So I looked him up. And he says Tesla was a giant of innovations because of his contributions in the field of electricity, radio, and robotics. In fact, his equivalent, he was, in terms of what he did, he was as accomplished as Thomas Edison. But unlike Thomas Edison, he didn't manage to build successful alliances with those who could finance, build up, and scale his creations. So, as they say over here, his life shows that even for a brilliant inventor, innovation doesn't happen in a vacuum. It requires a broad spectrum of talents and skills and lots of capital. Why I talk about this is to relate this back to this notion of discovery resources. You might think, why are they raising funds in Australia for a project in Africa? That's because Australia, for a variety of reasons, or Perth in particular, not just Australia, but Western Australia, is the Silicon Valley for mining stocks, exploration stocks. If you want to explore a deposit or a particular province or area anywhere in the world, then Australia is one of 2 or 3 places that you come to. So in Mongolia, in South America, in Africa, in Asia, and of course in Australia as well. It's got the resources. Now, why it has that is an interesting point in the lecture in itself, but the point being, we've got the financial infrastructure to allow people to bring these projects to fruition, whereas in other places in the world, they don't have that. It's not enough to invent it, or not enough to discover it. You also need to be able to bring it to the market. So the person who brought the electric vehicles is, of course, this man, and it's interesting that I probably don't have to put up his caption to say who he is, because most of you would recognize him as, well, I won't say it. Elon Musk. So he's the Tesla's founder and chief executive. So he's earning a reputation as the Trump of the corporate world. This isn't necessarily a compliment in the context of this paper. And so, like Trump, in the sense that he decides the rules of the game, he doesn't decide. And one thing that's amazing about this is I've listened to a lot of analyst reports. So, and I've read a lot of analyst reports and transcripts of conferences with the CEOs. So the CEOs of these companies are normally people who in the everyday are used to people listening to them reverentially and saying, oh, yeah, no, yeah, of course. What do you really think? Yeah. But a earnings conference is the one time when they're placed on the back foot, because then they have to convince the analysts that they've got a good business. So this is them now being a little bit tipping their cap to the analysts and saying, oh, yeah, no, yeah. Except Musk says, you're a boring bonehead, and I'm not asking you any of these ridiculous questions. And he told day traders to sell out if they did not like the volatility in the share price. Still, with all this behavior, Tesla hits a new milestone, passing General Motors in valuation. Back in the mid-20th century, way back then, there was a saying, what's good for General Motors is good for the US. So now we have Tesla, a company that hardly makes any cars, passing General Motors, that's been around for over 100 years, passing Ford in valuation. It's come down a bit since then, but still remarkable. So this is the common story. So Bruce Grunwald says, it's nuts. Investors believe it's going to dominate a market that no company has ever dominated before. He wrote, and this is the standard theory, the standard finance, stock prices represent risk-adjusted future cash flows. I'm not saying he's wrong, I think he's right, but stock prices reflect risk-adjusted future cash flows plus the value of the growth options. That's what he's not including over here, which is why he finds it's nuts. And he goes on to, similarly, in another earlier statement in May 2015, Andrew Ross Sorkin says there's no meaningful stock valuation for these shares. These values are based on what a small handful of investors, usually venture capital firms, private equity firms, or other corporations, are willing to pay for a stake. Now, there's a clue here that this is an irrational. These companies venture capital firms, private equity firms make their money by being smarter than other people, by being very careful with who they invest in. So if these companies really had no basis in rationality, they wouldn't be putting their money in. But no one knows how they actually fund it. He says valuations are the responsibility of a cross-disciplinary valuation committee, which operates independent of portfolio management. In other words, there's no oversight. The factors we consider include significant transactions, securities, new rounds of financing, the company's financial and operational performance, strategic events impacting the company, and relevant valuations of similar companies. In other words, we're not going to tell you anything. We'll just, you can make up your own mind, but we're not telling you. So the dot-com, now to put this, to show you what we're trying to explain here, the weirdness of this is Tesla as a dot-com, and these are the companies they've been compared to in the last 2000 crash, which you might have heard of, the 2000 dot-com crash, when you had companies like Pets.com, where you were selling the pets over the internet, the Globe, eToys, etc. The price to book ratio of Pets.com was 1.7. The price to sales was 23.4. So in other words, the company was worth 23 times the value of its sales, and it had a market valuation of 217 million. So all of these crashed. So Tesla looks sort of similar, well, a bit better than some of the worst ones, but still, compared to General Motors and Ford, it does seem a little bit overvalued. So how does it get such a value? And this is the point here. It has something hotter than cars to sell, its story. He says, Tesla has ascended into a rarefied realm of so-called story stocks, that companies that have bewitched investors, that their stock prices are impervious to any traditional valuation, and their shares can stay up in the stratospheres for years, even decades. Amazon stocks surged for decades, even without meaningful profit, and more recent example is Snapchat. So most of these have stories that are compelling for investors. So I said, investors' stories are important. They help investors make sense of an array of disparate facts, and that's what's happened here. Someone like Elon Musk has marshaled all these facts into a compelling story for investors. But now, we showed that various studies have shown that stocks with high price to sales ratio on average significantly underperform market averages. So it looks like what's going to happen here is the same thing that's happened to a lot of WA companies, exploration companies. They're going to be worthless. They're going to crash. I'm fairly confident of that. Based on the history, that's going to be true. So what we have to come up with now is, how do we explain something that looks overvalued, people predict it's going to crash, and then a vast majority of these crash? How can we explain this with any basis in rationality? And it's not as though people there aren't alternative facts, as they say. So here we have, in the paper recently, Machine Pilot. A Machine Pilot is a pseudonym for a short seller. And so he's trying to get these facts to tell people that Tesla is way overpriced. And one of the things he's doing is he's flying over and taking photographs of this transport rigs over here. And he's showing that these lots are filled with cars, or in some cases no cars, but they're certainly not moving. More than 100 car-carrier trailers, the kind you see hauling new cars, they're lined up in neat rows, empty, idle. In other words, Tesla is claiming that they're making all these cars and selling them. They can't meet demand, and yet it's not moving. So, but on the other hand, you've got this, there's no mystery. Tesla said there's no mystery to the car for the distribution points for final delivery to customers. As to the empty trailer, a Tesla spokesman said, not all our carriers would be in use at all times. Some might be in maintenance. So you have a competing story. How do you tell? And that's the thing. you can't tell. To have a fact, you have to rely on someone else's knowledge. You have to rely on some kind of a story. And I think the problem with the short sellers that they have is that while they're a disparate mass of people, none of them have combined together to tell a compelling story in the same way that Elon Musk has. So that's their problem at the moment. But there are a lot of short sellers. Of its 773 million shares, 17% are held by short sellers. So what's the truth? You have here, his 2017 assurance to Wall Street analysts that they should have zero doubt that Tesla would hit a production level of 10,000 cars a week. The company has yet to achieve a steady rate of half that number. He put up a solar tile demonstration saying that would revolutionize the residential solar market. It turned out to be a non-functioning fake model. But the shares are still up. So that's the share price from here, $268. One of the things is you want to tell a clear story. You want to keep yourself in the news. So part of this is keeping yourself in the news. This is the behavioral finance. So I had a look at this and I checked him out. I thought Elon Musk versus Kim Kardashian, whom I thought would be a good benchmark. And this is a standardized rating on Google Trends. And here you see that Kim, over this period, the last 12 months, Kim was the highest. And Elon Musk, the highest he reached was 50% in May something 2018. But otherwise, she seems to be doing a better job of being in the public eye than he is. Lithium, not doing so well. You'd be better off investing in Kim if you could. So, we're witnessing our second tech bubble in 15 years. David Einhorn. And this is in 2014. This is the internet, a guide to the 2001 tech crash. So for those of you who were, well, just about all of you who wouldn't have been paying attention to the stock market back in 2000. The market, the stock market as a whole lost roughly $5 trillion in market value, which sparked a recession that lasted 8 months and shrank US GDP by 0.3. In contrast, the global financial crisis, the value lost was only 3 million. Now, what's the difference? The difference is that this was largely paper money. The shares went up and then they went down, but no one lost any particular assets other than this. So the value of equity in the US dropped by around 5 trillion. The US GDP is 13 trillion. In one sample company, the price went from $106.68 to $5.97 as of 28 September 2001, a loss of 94%. What I want you to do is think, how would you feel if you bought this company? What would your conviction be like as you see the company going down in price from $106 to $5.97? Because you're an independent thinker. So, Warren Buffett says, people are funny when it comes to the stock market. When the price of, I like hamburgers, when the price of hamburgers goes up, I cry. When the price of hamburgers go down, I sing the hallelujah chorus because I can buy more hamburgers. It's not the same with stocks. So if you really believe in this company, you must have felt really good when it went from 106 to 68 because you can buy more shares. Do you think anyone did that? Wake-up call. That was there. If you did, though, if you had the courage of your conviction, if you weren't thinking like the crowd, you might have done okay. This company was Amazon. So the value of Amazon now is, what, 300 something or dollars? So this was... But you know, if you sold along with everyone else, that's fine. I mean, you're only human. That's the way it works. The new tech bubble. The Economist talks about LinkedIn hopes to be valued up to $3.3 billion initial public offering. Microsoft purchase of Skype for 8.5, 10 times its sales last year, 400 times its operating income. Prices look even more excessive for fledgling firms in the private market. This is the new tech bubble. But look at the date, May 12, 2011. Do you remember the bubble that popped? Yeah? No? It's 9 years later, or 8 years later. No bubble. It'll pop sometime, no doubt. Eugene Farmer says, I've mentioned this before, he says, the word bubble drives me nuts. So if you go back to time, most people were saying the internet was going to revolutionize business, so companies that had a leg up on the internet were going to become very successful. So he says he did a calculation. Microsoft was an example of a corporation that came from the previous revolution, the computer revolution. It was highly profitable, hugely profitable and successful. How many Microsofts would it have taken to justify the whole set of internet valuations? I estimate it to be something like 1.4. So we've had pretty much 1.4. We've had Amazon, we've had Facebook, so it's not like it's been a complete bust. Okay, so the purpose of this lecture then is to show the point about this, I skipped this, but I've made this point earlier because I said this is the thing. The notion of a bubble is when it's the other people are dumb, not you. That's what people call bubbles. But I want to explain here that we can make sense of this by thinking of these stocks of Uber, not as when you're buying a stock, it's called a share, you're buying a stock, a share, but actually what you're buying is not a share, you're buying an option. If we value these companies as options, then their pricing and those valuations make perfect sense, including, and the crash makes perfect sense. There. So options, so you think of them as real options, and so when I talk about a real option, I'm talking about any option that's not a financial market option of the kind that that you recognize. So quickly, I'll just go through what options are, and then I'll give you an example and apply this to real options. So the call option, the right to buy at a particular time at a fixed price on or before a specified expiry date. A put option, the right to sell on or before a specified expiration date. So we have two stocks, X and Y, and this is the probability, and this is the share price. And this is the probability of distribution of the share price over a period of time. So stock X is this one. Stock X will go from 5 to minus something to, well, not minus, to 0, and it could also go very high. But stock Y trades in a much narrower range. So which stock is riskier? This one is X and the blue line is Y. So which stock is riskier? Come on. Someone. The what? X, right, thank you. X is riskier. Why? There's more volatility in the price. So at an exercise price of $8, which stock's option would you prefer to own? Sorry? Anyone? Which stock is more attractive? If you had an exercise price of $8, which stock's option would you prefer to own? X. So why? X. Because you've got more chance of it hitting a high price. You don't really care if it goes below negative. What you really worry about is the upside. So now we've decided something counterintuitive. The riskier the stock, the more attractive the option value, the more valuable the option value. So hang on to that thought. The more story you can weave about a company's upside, the riskier, the greater it thinks, the more attractive it becomes. You don't worry about the downside because the downside really doesn't matter. What you want is the possibility of that upside potential. If it stays the same, if the price is $5, it doesn't lose any money, but it's not attractive to you. So it's not the status quo, whether it stays at 0 or goes to $5, $3, $4, it doesn't really matter. You won't make any money. Anything less than $8 is unattractive. So the value of this option really depends on how risky, on the upside of it. So as you lengthen your investment horizon, does the probability of the exercise price exceeding the share price increase or decrease? So the more time you have, how likely is it to exceed $8? Bad things can happen, but also good things. And for good things to happen, the longer you wait, the more likely it is that some good things will happen. So the option is valuable the longer you have to exercise it. Now, you bought an option on security XYZ for $4 on the 1st of January. The option is valid until 31st of December. Exercise price is 12. When you bought the option, the value of the underlying security is $9. It's now June 30th. The security price has risen to $30. So if you exercise the option now, you would sell the stock for, you would buy the stock for $12, and then you'd sell it for $30, and you'd make $18. Analysts are predicting a high probability that it will fall. Should you exercise the option to buy? It's an American option. Sorry? Yeah, good. Sell the option. You wouldn't sell the option for anything less than $18 because that's your profit that you're going to make. So you wouldn't sell it for anything less than 18. But if the option itself has some value. So by selling the option, you get at least the profit you expect to make plus a bit extra for the option's intrinsic value. So that's okay. So this is. I used to try to scare people by saying we'll go through this slowly now, but that never convinced anyone, so I'll just go there. We'll look at the determinants of options values are a function of 5 things. The value of the underlying asset, the exercise price, volatility, time to maturity, and risk-free interest rate. You should memorize this. This is very useful. Some vacuuming. The factors influence the value of a call option. An increase in underlying share value. The call option will increase. The increase in exercise price. That's how much you have to pay to acquire the asset. That will be decrease. Increase in variance of share price. The riskier the security, the more valuable the option. The time to expiry, the longer you're able to keep the option, the more valuable the option. The increase in interest rates. The higher the interest rates, the more valuable the option. And let me explain this. If you're buying a share, going back to this share, the security price is $30. If you buy the option to buy, it's much less. So by buying the option, you still preserve your capital. You have your capital, you're not spending it. And therefore, the higher the interest rates, the more money you can save up, the greater the opportunity cost of capital. So buying an option gives you the benefit of a claim on the asset without actually holding up your asset, using up. So the higher the interest rates, the more valuable that option not of having a claim on it without using up all your capital. The put option, an increase in underlying share value, goes down. Increase in exercise price means you can sell it for higher, that goes up. Increase in variance goes up. Increase in time to expiry, that goes up as well. And the increase in interest rates. So if you have a put option, so an increase in interest rates means that to exercise the value of the option, so you sell something, then you have a high cost of, you earn more money. So an increase in interest rates increases the value of the option as well. Okay, we'll take a break there, come back at 5:02, and then I'll apply this to the theory. Okay. A key point in understanding this next part is to appreciate that when you're buying a derivative, you're buying a levered investment. So a levered investment is one that exposes you disproportionately to highs and lows. When things go well, you earn a disproportionate profit. When things go bad, you earn a disproportionate loss. So, and here I want to illustrate how a derivative is a levered investment. So let's say you have an option versus a stock investment, and your question here is, should a call option investment be preferable to a direct share purchase? What circumstance could this arise? Your favorite cousin calls you up and says, I've got this great tip. I'm working for this company, and here you're at your family's place over the holidays, and he's trying to impress you and to make you even more firmly the favorite cousin. And it says, in the next 6 months, this company's share price is going to go up, that I'm working for. We're working on a really good, an announcement will be due any day soon. So you think, favorite cousin, never lied to you before, good guy, and what have I got to lose? In fact, I've got a lot to gain. So I want to invest in this, and I want to maximize the benefit of this inside knowledge. You've got $10,000 to invest, and you have a choice. You have a choice between buying call options or investing directly in the shares. So a 6-month call option costs $10, or if you want to buy the stock directly, it costs you $100. So you could invest directly in stocks. This is the safer kind of investment. Or you could invest entirely at in-the-money call options for $10 each. You buy 1,000 calls, so that uses up your $10,000. So just to show you your two strategies, equity only, buy 100 shares at $100, uses up your $10,000, or you buy your calls, 1,000 call options at $10, that uses up your $10,000. Now let's have a look at the strategy payoffs in the next 6 months. And to make it simple, we'll look at this in 5 scenarios. The first scenario, and so we look at the payoffs to the equity option versus the call option. Equity investment versus the call option. So you eagerly buy, you put down $10,000, and the share price goes down to 95. You call your cousin, he doesn't pick up the phone. So it takes some time. You finally call him, and he says, I haven't been able to get in touch with you. He says, look, I'm sorry. I made a mistake. The project didn't go as well, so we're having a bit of a loss, and so, look, I'm sorry, but you haven't lost so much money, have you? It's only down 5%. Now, if you bought equity only, you'd be down $500. So put in $10,000, $95,000, you write off your cousin from the Christmas card list, you put down the $500 to learning experience, so that's it. You move on with your life. If you invested in options, though, you've lost all your money. You tell your cousin exactly what you think of him. You tell your grandmother what you think of your cousin, and basically you write him off, and you spend, because you're pretty annoyed. You've lost $10,000. The next scenario, $100. You ring up your cousin. Takes some time to answer the phone, but he does and says, look, it's all good. It's all good. We're just a bit delayed. The announcement will come in the next... But the share price hasn't done anything. So you haven't lost any money, have you? It's all good. Just relax. I've never lied to you. Except I got it wrong this time. It didn't. If you bought equity only, you might say, I always knew he's an idiot, but you wouldn't really worry about it because you haven't lost anything. But if you had options, the price hasn't moved at all, and you've lost everything. Because an option to you to buy when it's at the money and it doesn't move is worthless. So there's no joy there. At $105, you call him, and he picks up the phone pretty quickly and says, yeah, look, it was good. We made an announcement. Didn't go as well as we expected, but, a 5% in 6 months, who can complain? You've done well, haven't you? If you bought the equity options, you'd say, yeah, we did well. $500 profit, 6 months, not too bad. But if you bought options, you'd be out. You'd be annoyed. You wouldn't get too upset, but you'd be annoyed at your cousin. He's lost you half of your $10,000. At $110, you call him up, he picks up, he says, yeah, great, fantastic, it all went well. Could have been better, but, it's 10%, really, really good. Hope you're thrilled. We look forward to seeing you at the next, at Grandma's place, the next things. And you've made $1,000. You haven't lost any money on the options, and maybe you'll say hello to him. At $115, he calls you, you go out, you celebrate, everyone's happy, and you think, yeah, I always knew he was a good guy. He was my favorite. But the point I'm trying to make over here is, with these story stocks, it's not enough for them to remain at the same things. They have to do something dramatic. It doesn't matter if they say the same. It's the upside that matters, not the downside. So if they stay the same, it's the same as having zero, losing all your money. So with Uber, it's losing $1.8 billion. That's not where the value is. The value comes from if it actually goes on and builds on those 91 million customers and converts them into profitability. So you have to sell that bigger story. It's that story that you're selling, the upside, not the status quo. So the all option portfolio responds more than proportionally to change in the share. It's levered. And my point is, it's the same thing with these kind of technology IPOs. You're buying an option in these companies. If they stay the same, you're going to lose money. It's only if they fulfill some of that promise. So that's where these are the growth options. That's where they come in. And so a contemporary example here, I'll give you two examples, then we'll apply this formula. We have Yahoo set to acquire Tumblr for $1.1 billion, and Marissa Mayer, CEO of Yahoo. This person says, it may be time to start worrying about a tech bubble again. Not really worrying so much, but news that Yahoo has paid a fairly whopping sum suggests that we're in a bubble. They say, the company had 13 million in sales. 13 million in sales. Tumblr's $1.1 billion price represents the richest valuation for a dot-com company since 2000. Using any conventional metrics, the price is absurd. That's true. The conventional metrics, the price doesn't make any sense. But it's about the upside. It's about the future value. And this is the key point about an option. Yahoo, Marissa Mayer is buying Tumblr because it gives her access to a market, the eyeballs, or she thought at the time, that other people wouldn't be able to get. So if she got, at the time, people were thinking, what's going to be the most popular media, social media application? If we bought Tumblr, there's a huge prospective market. If we capture that, and no one else can, that's the important thing. It's not enough for you to be able to capture it. It's to be able to exclude other people from capturing it. And this is a point that's relevant to your assignment. This occurs to me when someone just came to me just now and asked about a potential pick and shovel strategy. And I said that they might want to reference a real option approach. Because if you're buying a company that is uniquely positioned to take advantage of a lithium boom that other people don't have the opportunity, that's what that real option embedded in it makes it valuable. So when you're analyzing your investment, you can think of it in that particular way. Look at the real option worth of the company. So that's Yahoo's this by way of showing that, she didn't make her money by doing dumb decisions. She took a gamble on this company. This is LinkedIn founder, Reid Hoffman. He's so happy because in May of 2011, his company went public and it sold for $94 a share. And the Weekend Australian Self-Help wanted to explain the rocket-fueled IPO of LinkedIn. It's valued at $8.9 billion, while the revenue was just $243 million and net income was $15 million. The skeptics turned a spotlight on LinkedIn, but 2 years later, it had 155, shares price was $155, $205, and then Microsoft took it over for $196 per share. Not so much a bubble. People, though, at the time, and this is, I think I've said this, given this example before, but Robert Jarrow is one of the eminent economists, financial economists. They looked at this company in 2011, about the same time it went to an IPO. They developed a model, and they said, yep, this is definitely a bubble. We used our methodology to test whether LinkedIn's stock price was exhibiting a bubble. We found definitively that there is a price bubble. No. So what is a fact? What isn't it? These people found definitively there is a bubble. How to make sense of this? Well, why would people pay so much for this company? And now just a little bit of economics for you. Something you mightn't appreciate because you're on one side but you don't see the other side is that for companies, finding good employees is very, very difficult. Getting the right employee at the right time, at the right price is a difficult and challenging task. And I can tell that from experience, from the little hiring that I've done, that it's very difficult. So to give you an example, if someone who's, say, $100,000 job, it might cost you, to get the search right and everything, it can cost you up to $25,000. So just to hire someone, you're paying them $100,000. There's a $400 billion recruiting industry. It's phenomenally profitable. So here's LinkedIn. By getting LinkedIn, you have an opportunity to actually capture that market. So if we value LinkedIn, a share in LinkedIn as an option, then this is way back in 2011. Notice there's no indicator that it would be successful, but there's a probability. You're telling a story. So the underlying asset of LinkedIn is the size of the recruitment market, the cash flows from advertising, subscriptions, recruitment, etc. That's the underlying asset. Or the exercise price is the further investment to develop LinkedIn, which to make it work. So you buy the company, then you have to put in some further capital investment. But this is where the variance comes, the most value comes. The potential size of the market. The bigger the story you can make about this, the bigger the valuation of the company. So when we talk about Elon Musk and Tesla, the bigger the story that he can say about the market that Tesla can potentially capture, the more valuable that company becomes. And as I show you, it's not just the electric market that he's talking about. He's talking about the electric vehicle market. He's talking about the electricity market and also the home delivery services market. So he's really broadened that spectrum of the market that he thinks that Tesla Corporation could capture. The fourth thing is the time to expiry. And here, an issue here is the first to the market. So you've got Amazon. Now, there's nothing particularly secret about Amazon, but the next company that tries to do the same thing as Amazon will face a very challenging task. So Amazon is effectively got very high barriers to entry. It will be a long time before someone can compete against them. So they have an almost, not quite infinite, because no company has an infinite, but a long time to expiry. And the interest rates are low. So my point here is, to explain why a lot of these will crash, that these investments are levered investments. If Tesla comes good, and it'll have to come very good to be able to justify its valuations, but if it comes good, people will make a lot of money in the same way that Amazon did. But it's more likely than not that Tesla won't be successful. So there's a high risk. So this explains why the majority of these options, expire worthless, but a few of them will be really valuable and they'll make up for all the rest of them. So as I said, this is, if you had the conviction in Amazon, at 106, it went down to $5.97. If you bought it $5.97 in last year, it would have been 11,133% your return. So the point was made here is that there wasn't maybe a tech bubble. People thought that the internet would revolutionize the world, and it did. It just took 15 years longer than people expected. And another point, which is the thing about Tesla's story, that Tesla isn't about just the vehicles. So it doesn't matter so much that it's not shipping out the vehicles, but it's also the fact that it's going to dominate. There's a possibility that it'll dominate the solar and battery technologies, and also the Uber, the home delivery service. So if we think that Tesla's shares buying a share in Tesla gives the option to share in the upside, does its valuation seem so irrationally exuberant? If you look at it that way, it seems a fairly sensible story. I mean, Elon Musk might appear a prat. I think there seems no doubt about that. He's a prat. But by the same token, that's irrelevant to the valuation of the company. So, onto real options. The value of many companies embeds these real options. They give an opportunity to take advantage of situations which they alone will be in a unique situation to benefit from, and not others. That's where an option is only valuable if you can capitalize on it, other people can't. So let's give you an example. Say you like anthropology and psychology, but don't know which field to specialize in. A general course allows you to make deferring a decision until third year. Which course would you pick? So if you don't know what to do, then the course that you might pick is commerce. People do commerce because they think, oh, I don't know what to do, so you end up doing commerce. Or what we had at UWA was this, when we had a new courses, we thought, if most students, it's unreasonable to expect them to know what to do, so we'd have a general course and give them an opportunity to specialize later. That was the idea, but it turns out that it might be a bit costly because some people now, if they do know what they want to do, then it simply delays the time in which they can specialize. The thing about the real options critique of standard NPV calculations, and so there's a lot of text on this, but I simply want to make the point here that without taking into account real options, the value of many companies is understated. So if you look at just the discounted cash flows, but you don't take into account the real options, then the companies will be systematically understated. Let's go to an example here. So I was telling the class, this example has come up in 3 of the last final exams. So the question you have to ask yourself is, will it come up again? I'll go through this slowly, okay? This will be easy. But the situation here is you have an oil company which has the right to explore in 2 areas, 2 different separate areas, 2 separate licenses, but they're very close together geologically. The probability of success beforehand is 30%. The drilling cost is $30 million. And if we find oil, so conditional on finding oil, will make $95 million. Okay, so in total it will be $190 million if we're successful in both. That will be the NPV. However, if you do the discounted cash flow here, we find that the expected value is minus 30. So that's the cost of drilling. 0.3 multiplied by 95 million is, so this gives you a total of minus 1.5 million. You walk away from the company. You think it's not worth it. I'm not paying a cent for this because the value is worth minus 1.5 million. That kind of analysis hasn't taken into account the real option value. What's the real option here? The real option is that you don't have to drill in both areas. You can wait until you get some information about drilling in the first area before you drill in the second. That's the option. So you can choose to not drill in the second area. So once you have information, once you know whether you're successful or not in the second area, then in the first area, then you can decide to drill. What difference does that make? Well, it turns out, because these two places are located very close to each other, so you know that if you're successful in the first, then there's more likely to be oil in the second area, which is just next to it. So the probability of success goes up from 0.3 to 0.5. On the other hand, if you fail, then the probability of success decreases from 0.3 to 0.21. So success, and then conditional on the 0.3 successful, we know that we have a 50% chance of being more successful. If we're unsuccessful, then there's a reduced probability of finding oil of 21%. So you don't need to drill in the second area, it's an option. So in the second place, if we drill and we find no oil, then we stop. We're out by minus 30 million. But in the case of positive news, now there's only 30% chances that it's probable. The revised expected value from drilling in the second place is 17.5 million. So it's 30 million, you're losing 30 million, and then there's a 50% chance of you finding oil, and in which case you'll make 95 million. So the present value here is 17.5 million. So the value of the two, so combining this now, if you, considering that you can wait before you decide to drill in the second place, the combined value is this. The expected value from the first drilling site is minus 1.5. But that gives you some information which you now use. You know that before the fact, it's 30% probability. Now, at this point, you don't know. So there's still only a 30% chance that you'll make this 17.5 million, because that's the NPV from. So the 2 minus 1.5 million plus 70 times 0 plus, because you won't drill if you don't find oil, plus 30% times 17.3 is 3.75 million. By looking at that real option, you find that the company is actually worth 3.75 million, not worthless, not minus 1.5. Now, it's pretty late in the day. You've been through a lot, so if you haven't understood that, relax. Your tutor will go through it, okay? He'll go through it very slowly, and you look at it yourself, and eventually it'll make sense. The thing will resolve itself. The point, again, is that the discounted cash flow underestimates the value of options, where the owner has the facility to expand a project, conditional on good news, delay an option to abandon the project, or an option to delay further investment in response to new information. So this is the article I want you to read, and it explains it very clearly about the different kinds of options that you have and how much they might be worth. So I think in any situation that, and as I said, this could be useful for your assignment. You could apply this looking for those kinds of investments that give you an option to take advantage of the lithium market. Okay, so to give you an example of a timing option, sales of low-fat ice cream are surging. The healthy cow is considering when to expand its plant. And so the expansion would require big upfront investment, and the companies can't be sure that the sales boom will persist. They have the option of delaying the investment until they learn more about the strength of the demand. And then that's a timing option. That's something that you would include in your... Friends to Friend, a company selling cosmetics, is trying to decide whether to enter the vast Chinese market. So the initial investment to build a manufacturing and sales organization would be large, but it would lead to this option to sell a whole range of products to an established sales network. So again, this is an opportunity. Should you invest in a manufacturing and sales, or simply have just a sales component? Okay, the lithium assignment. So the question is that your plan for your assignment? What do you have? Do you have a plan? And if it is it something that you can laugh about? Or if you're feeling lost, I don't want to make too much fun of it. I appreciate it's a difficult assignment, but so I've got James McClements, and he just emailed me earlier to confirm that he's going to come and give a talk, Q&A. So he's going to bring 2 other people with him, people who are in the industry, and there'll be a Q&A. They'll talk for about 40 minutes, or maybe 30 minutes, and then have question and answers, and it'll be from about 6 to 7 o'clock. I'm sorry it can't be any earlier, but that's the time to book the venues, and also they're working. They've got a full-time business, so that's... But he owns a Resource Capital Funds, which is a private equity firm. They've raised up to $7 billion. So another thing you might like to come, even if you're not particularly interested in the lithium assignment, or if you are, is just to listen to someone who's actually, and see how he talks. See how someone presents, who goes to people and raises money. And when he goes and raises money for a fund, it'll typically be in the tens of millions of dollars at a time, not just hundreds, but tens of millions of dollars. So that'll be interesting in itself, watching people. Okay, I seem to have finished a bit early, but this is where I finished in the last one, so I don't want to give you an unfair advantage. No, so the talk will be on the 29th or the 30th. So a bit too close to the final exam, I'm sorry. I mean to the submission, but they're confirming with me. I'll put it up when they confirm it the next day or so. You can practice. In the meantime, you can talk about this. And the... What else was it?
Distinguish between the size of market, they also appear size of market, but these 2 variables will impact the value of option in different directions.
Question 3?
Oh.
Just all right, sorry.
Because I finished the quizzes now.
All right. Oh, did you go to the morning lecture?
Yeah.
All right.
I came early morning.